Alrighty, what is going on, everybody? Welcome back to another CYPRX video banger. In today's breakdown, we're going to do some fundamental and technical analysis surrounding the digital asset space, specifically focusing our attention on AGIX and HBAR. Last week, we had some phenomenal callouts that we made publicly available both on X and YouTube, and we got a lot of positive feedback and people seemed to like it. So we're going to continue to carry on with that analysis. For the sake of the length of this video breakdown, I'm going to cut off ICP. I'll flip-flop back and forth between HBAR, AGIX, and ICP technical analysis on the YouTube space. In today's video breakdown, we're going to cover some fundamental analysis, informing you guys and educating you all on why risk assets have been so bullish, what to expect in the short term, and what to expect via the weekly outlook for market volatility this week and potential price direction, given risk on, risk off market sentiment that we are set to experience because of fundamental data. So if you all enjoy these video breakdowns and they educate you in some way, shape, or form, regardless if it's teaching you technical analysis properly or educating you properly on fundamentals and what to be looking for as a risk asset investor on the fundamental US data front for market direction, do us a favor, smash that thumbs up button and subscribe to the platform. It does help these YouTube video breakdowns get pushed out to more individuals like yourselves, and it does boost the algorithm. So we do appreciate the love and the support. So I'm actually going to start off with just a positive quote for you guys, just to keep the momentum going. I try every single fundamental video breakdown for you guys, just to give you guys some informed viewpoints of the market. So we know that 95% of retail traders entering the market experience failure. This is often attributed to their mindset, their expectations, and their deficiency in knowledge and discipline. Okay. I know that that seems pretty I guess you could say repetitive, right? The statistic that 95% of retail traders lose in the market, but it is honestly because the vast majority of people come into this space with lack of education. They don't want to put in the work. They don't want to put in the time requirements that it actually takes to pull money from this market. And they consistently lose. They lose then faith in themselves because of the fact that they have not mentally prepared themselves to experience failure, and be able to actually adjust to that failure. So my advice, obviously, of course, it's not financial advice, more so psychology advice, is that if you are experiencing failure in this market, it is most likely prone to user error. It is not the market that is causing you to lose. It is because you were not well prepared to take on the smartest algorithms in the world by learning fundamental analysis, learning technical analysis, and then also understanding yourself, excuse me, on another level, right? Understanding how you react in high stress situations, understanding how you react when you have other stuff going on in your life and you're put in a very stressful situation where there's volatile market activity. Okay. Putting yourself in a situation where you understand how you react when you lose money in this market. Okay. How do you bounce back from that? Do you collect the data? Do you zoom out and figure out what you did wrong to try and fix those mistakes? Or do you quit and fall and break under the pressure, which is, again, the vast majority of people? They come into this market, they download an application, they get wrecked, they lose some money, they think it's a scam, they get out, pass it on to the next one, right? So you have to ask yourself, are you different? Most likely, if you're the type of person that's going to sit through an entire video breakdown like this, where we're going to go over fundamentals, we're going to go over technical analysis, then you're already part of that 5%. The 5% of people that want to make a difference, the 5% of people that want to actually show up, be here, and pull money from this market on a consistent basis, right? So kudos to you, pat yourself on the back. The last thing to do is for you to correct those tiny mistakes, correct your mentality, join a community that pays attention to fundamentals and actually teaches you how to read them, and then teaches you how to apply those fundamentals either positively or negatively to price action. Okay, so enough of that spiel. Let's get into it. So let's understand, let's always do a market recap. As a community here at CYPRX, we like to understand why our assets were either bullish or bearish. Well, we know last week we witnessed record highs in the stock markets as as corporate earnings outperformed expectations, which drove investor sentiment. The market was strengthened by rising corporate profits, reassuring comments from Federal Reserve officials, and a sustained low value of the dollar below the 104.100 and the 104.00 psychological levels. Now, the optimism surrounding corporate earnings, coupled with semi-dovish comments from Fed officials, led to a surge in risk assets last week. Obviously, of course, this has been ongoing since pretty much late October 2023, where we've seen an uptick in risk assets due to and primarily driven to the whole entire rate cut narrative that at some point in time in 2024, the Federal Reserve and other major global central banks are going to start to cut interest rates, leading us into a lower interest rate environment, right? Crypto market capitalization also rose to 2.0%, passing and surpassing $2 trillion, with notable gains also seen in major indices such as the S&P 500 hitting new all-time highs and the NASDAQ Composite. Notably, we also had NVIDIA Corp seeing a remarkable surge of over 10% last week following positive earnings, further bolstering market confidence. Now, I'd also like to issue in the fact that AI tokens rallied as well amid the NVIDIA's breakout earnings. So we also had that correlation, which was very significant. We were calling out buys last week on AGIX, all the way from roughly around 44 cents up into 65 cents and 75 cents, which is where we're currently sitting at now. So hopefully you guys were capitalizing on those call outs because we made them all in advance. Let's go back to this one. So I said, looking ahead to the upcoming week, caution is warranted despite the prevailing optimism. Why is this? Why do we not need to get ahead of ourselves, and why do we need to be data dependent? We're going to get into that, okay? Because the market is extremely euphoric right now. Everybody's being extremely greedy. Everybody's most likely in profit that got in at some lows during the beginning of this year or last year. So when that takes place, it tends to cloud retail judgment, where they stop seeing fundamentals and they stop believing that a market pullback could happen. They don't take profit, or they don't prepare themselves with cash on the sidelines to get in at another discounted opportunity if the situation arises. So that's what we're going to be going over today. So semi-optimistic views from Fed speakers and the market's inclination towards the expectation of central bank rate cuts have fueled greed and risk assets that we have gone over. However, attention will be on inflation metrics, particularly the core PCE deflator, which is anticipated to post a slight decline in PCE year over year from 2.9% at previous readings to 2.8%, and post a 0.4% month over month increase from previous readings of 0.2%. So that is what we're going to get into today. Ideally, as risk asset investors, and this is going to get repetitive, but just so that way you know, as risk asset investors, ideally what we would want to see is lower inflation readings both year over year and month over month to sustain, ideally, a risk on market sentiment and to see further continued dollar weakness. So that leads us into the second market analysis, and more so looking at fundamentals on a weekly basis. What is set to come out this week on Thursday, and what should be our primary focus this week for market direction? So I said to the private CYPRX community, this week holds significant importance for risk assets, with our primary focus centered around assessing the strength of the dollar and gauging inflation readings to anticipate the Federal Reserve's approach to potential rate cuts in 2024. Currently, the core PCE price index is anticipated to release with mixed sentiment, where the core PCE year over year is expected to show a slight decline from previous readings of 2.9% to 2.8%. And I'll show you that real fast. You guys can go. Remember, I've shown you all free websites. I personally use the Reuters, people yell at me for saying that wrong, the Reuters terminal, which is extremely expensive. You have to pay for it month to month, but there are free platforms that you can go and track this information. For example, investing.com or Forex Factory. And you can see right here the previous readings, and the reason why we had a bullish uptick in January 2024 is because the year over year core PCE price index came out with a slight decline, where the previous readings were 3.2%, the forecast was 3.0%, and the actual reading came out with a slight decline to 2.9%. So we are seeing that inflation gauge come down to the overall goal of the Fed's target of 2%. Okay. Now, the year over year here, we can see the previous reading 2.9%, and the forecast reading is 2.8%. So ideally, we would want this to come out with a slight decline from previous readings at 2.8%. Okay. So that's the year over year. Now, what we need to be paying attention to is that the month over month is actually set to come out with a slight increase. So that's where I wrote that this data could come out mixed. So I said, while the core PCE price index month over month is actually forecasted to increase from previous readings of 0.2% to 0.4%. Ideally, for risk assets to flourish, we hope to witness both figures experiencing a slight decline alongside the dollar being suppressed below the 104.00 psychological level, which we will get into today. Now, this part is extremely important because we need to understand, again, looking at the markets and where the markets were back in January when the core PCE price index showed a slight decline, what took place. which can give us sort of a sentiment and an understanding of what could potentially happen if we see lower inflation readings this week. So reflecting on past readings and the factors driving momentum in risk assets, which we know have been the rate cut hopes, fueling greed in risk assets like the stock markets and crypto, we recall that the beginning of 2024, when the core PCE price index year over year exhibited a slight decline from 3.0% to 2.9%. This reinforced the narrative that the prevailing interest rates are effectively working to gradually curb inflation towards the Federal Reserve's goal of 2%. Remember, I said this stuff is going to get repetitive, but it's extremely important to understand. Now, let's go and observe the charts of the digital assets from back on January 26, 2024. So if you go look at the date of when this data came out, you can see January 26, 2024, right? When we had that data come out where we saw that decline in inflation. So if we go back and we just look at HBAR as an example, and we can also utilize AGIX as an example, but you can see here, this is that the green circle is when the data came out, January 26, right? So you can see here, this is a copy paste article from Reuters, and it says there were no real surprises on the inflation front, with the core personal consumer expenditure deflator, the Fed's favored measure of inflation, coming out at 0.2% month over month, and the year over year rate at 2.9%. So there was a slight decline from previous readings at 3%. And you can see how the market reacted to that, right? Holding on to the narrative that the Federal Reserve is at some point in time, because of a decline in inflation, going to cut interest rates or not need to hike interest rates any further. Look at how the market reacted to that decline in inflation, right? We saw a slight pullback so that market makers could buy back in at a discount from where they previously bought from before the inflation reading came out, right? And then we saw bullish momentum continue in risk assets, not only on HBAR, but you can go and track this. Since we're specifically focusing our attention on AGIX and HBAR today, you can also see this apparent in AGIX's price action as well, where again, this green circle right down here is that date, the significant date of January 26, where the core PCE price index last reading came out with a slight decline, right? So ideally, why I keep mentioning to you guys what we want to see this momentum continue higher is, again, a further decline in this inflation reading, right? If we get the opposite, this is why I've been telling you guys to pay attention, because if we see, remember, the rate cut narrative has been pushed back. At the beginning of the year and last year, in 2023, as the year ended, what was the prevailing narrative? That rate cuts were going to be issued in March. Well, that has been completely weighed off the table as of right now. I believe it has like a 5% chance of happening, okay, via the CME Fed Watch tool. So if we see lower inflation readings, the percentage chance of a potential March rate cut could increase, followed with a potential increase in percentage chances of a May or June rate cut, okay? You guys see what I'm saying? Which would further bolster, most likely, again, it's not guaranteed, but it would most likely bolster risk sentiments, i.e. strengthen the narrative, right? Either sending the digital asset space higher, i.e. risk assets, or just consolidating at these highs for further market direction. We would most likely, if we see lower inflation readings and a weak dollar, not see a significant pullback on digital assets, i.e. risk assets. We would either do one of two things, in my personal opinion, which we'll go over in the scenarios, either consolidate around these highs, right? Or break higher, which is hopefully the scenario that plays out, right? Because just like you all, and I would like to see some explosive movement, just like you guys, but we have to be data dependent. So on the flip side, if this data comes out with an increase, both in year over year and month over month, based off of my market experience, that if we see dollar back above 104.00, heading back towards the previous highs of 104.9, followed with stronger inflation readings, we are most likely going to see a retracement in risk assets, okay? And I'll talk about via the price predictions of what that could potentially look like given the scenarios here in just 1 second. But let's just finish the wrap up. So just to give you guys an overview so that way you mentally and physically have it, you can see right here, all right? Consequently, I said to sustain this demand, we see continued declines in inflation readings, reinforcing the expectation that the Fed may lower interest rates at some point in 2024. However, we must remain reactive. I feel like I'm one of the only influencers out there that's actually telling you guys to be reactive to this data, okay? If the data comes out with a decline in inflation, cool. Bullish sentiment, risk on market mood, dollar weak, let's get it. Let's continue this bullish momentum. But here at CyPRX, we like to take profit. We like to make money. We like to reinvest our capital that we've worked so hard to gain, right? And so if we get a pullback due to higher inflation readings and a stronger dollar, why hold on to these assets when the market's going to tank or pull back to give us better buying opportunities? Again, it's just a question generally I'd like to ask, because there's a lot of people in this space that don't know how to do this. And it's, again, to revert back to the main way we started off this call, due to lack of knowledge, discipline, and education, right? There's nothing wrong with taking a portion of your long-term bags profit and re-implementing that capital into the market to grow your bags. Okay, nothing wrong with that at all, as long as you know how to do it. And I'm trying to teach you guys how we do it here at CyPRX, right? So I said, such as higher inflation combined with positive data reports leading to a stronger dollar nearing the 105.00 could, again, could, it's not guaranteed, trigger a significant pullback in risk assets across the board. I hope that that doesn't happen, but we have to be attentive and reactive if it does. This scenario would therefore most likely offer an opportunity to enter preferred assets at a more favorable price. Our objective this week is to maintain adaptability, respond to market dynamics, and control emotions, effectively manage risk properly to navigate the potential fluctuations successfully that we are set to experience. Now, we will get into a more intraday analysis here as well, with some fundamental data that's set to come out, i.e. durable goods orders and consumer confidence indexes. Okay. But let's just go over some price action scenarios for those of you impatient individuals that just want to hop off the call and get the TA. Okay. So check this out. Scenario number one would be the most ideal scenario, and the scenario that I would favorably prefer, which would be if we see throughout the entirety of the week. You guys can go to forexfactory.com to track all these fundamentals. I taught you all this in the previous video YouTube breakdown, how to correct your settings, just so that way you see US dollar fundamentals, which is our predominant focus for risk on, risk off market mood. You see here, the data that we're going to be paying most attention to this week is the core PCE price index and the labor market data, which is all set to come out on Thursday. Okay. So with that being said, scenario number one would be if for the entirety of the week we see downbeat US data, lower inflation readings, strengthening the rate cut narrative, i.e. furthering the percentage chance of a rate cut in March, which I don't think is going to happen, but just seeing the CME watch tool go from wherever it's at now, 5 or 10% of a chance, to maybe potentially increasing of 20 to 30% chance because of lower inflation readings, right? And then also, obviously, of course, a higher percentage chance of a rate cut happening in May or June of this year, okay? Dollar staying below 104. These are all metrics that need to happen for us to see a further bullish momentum move on risk assets, i.e. stocks and crypto. Dollar staying below the 104.00, heading towards the low 103s. And we would want to see a sustained risk on market mood. So no geopolitical escalations, no fear, uncertainty, and doubt causing demand for the global reserve currency, i.e. the US dollar. Everybody happy, go lucky that inflation's coming down, right? And a sustained risk on market mood. Okay. My bullish targets for AGIX would be a revisitation of the previous highs, roughly around 85 cents. If we see these metrics play out, if we can break the high at 85 cents, I'd be looking for a sustainable hold above 85 cents. If we can get that, my next targets would be anywhere between 90 cents and $1, right? Then obviously, of course, if those targets come into fruition, I will revisit the charts and make a decision whether or not that's a solid profit-taking opportunity or whether or not the bullish momentum is going to continue from there. Now, if we see the opposite, let's talk about scenario number two that we all need to be prepared for, okay? Where we could potentially re-implement capital into the market if we do see a market turnaround and the optimism in risk assets fades. This would be scenario number two. That would result in these metrics: upbeat US data, higher inflation readings, weakening. This is supposed to say weakening the rate cut narrative. Let's go ahead and correct that. Okay. Weakening the rate cut narrative, dollar staying above 104.100, heading back towards the previous highs of 104.9 to 105, a risk off market mood. My bearish targets on AGIX, I think I said ICP earlier, but we're on AGIX. I apologize for that. My bearish targets on AGIX first would be a pullback to correct some of this previous bullish move. that would put us roughly at around the lows of around 51 cents, right? So if we do see a break below 65 cents, and we see the bearish momentum followed with these metrics pick up, we see bearish closes, i.e. lower lows and lower highs beneath these higher lows here to the left-hand side. My first bearish targets on AGIX would be to come and revisit these lows here from the previous bullish run where we had the NVIDIA earnings come out upbeat, driving demand for AI crypto-related projects, okay? If we can break 51 cents, my bearish targets below 51 cents for some potential further dollar cost average opportunities rest at around 45 to 40 cents. That price action would look something like this: a sustainable bearish move, breaking 51 cents, closing below on the higher time frame 51 cents, and a further risk off market mood sentiment, dollar demand, outweighing risk sentiment, pressuring risk assets. 44 cents will be the next revisitation for some potential capital re-implementation. And if we break 45 cents, I'd be looking at 41 cents, i.e. coming and correcting this previous bullish move here, right? I can only see that happening if we see all of these metrics playing out. If we get mixed metrics, it's probably not going to take place, right? So upbeat US data, higher inflation readings, dollar strong above 104.100, heading back towards the 105, and a sustainable risk off market mood. Bearish targets all the way down 51, 45, and 40 cents on AGIX, right? Looking at HBAR. HBAR, same scenario plays, okay? Different targets, obviously, of course. So scenario number one, the scenario that we all hope for as risk asset investors would be downbeat US data, lower inflation readings, i.e. strengthening the rate cut narrative, dollar staying below 104.00, heading towards the low 103s, a risk on market mood. I'd be looking at a sustainable break above these previous highs, with next bullish targets being around 13 cents on HBAR, which here in the private CYPRX community, we have been targeting since all the way back in October of last year, right? I think the vast majority of CYPRX members have been in buy positions since roughly around 4.5 cents. At least I myself know that I've been, okay? So those will be our next bullish targets on HBAR. If we can break 13 cents, which I personally don't think that we will do, if we reach 13 cents, I think that we'll see another consolidation phase or maybe another market indecisiveness where we start to slightly pull back, see some profit taking. But if we do, heading into potentially futuristic targets, I'd be looking at 17 to 18 cents if we ever do break 13 cents. On the flip side, scenario number two, right, would be if we see upbeat US data. This is again supposed to say weakening rate cut narrative. Okay, would be the opposite. Upbeat US data, higher inflation readings, i.e. both the year over year and the month over month comes out above market forecast or above previous readings, which would be super bad for risk assets. Okay, it would horribly weigh on the rate cut narrative, and it would definitely drive dollar demand. Dollar staying above 104.100, heading back towards the 105, risk off market mood. My bearish targets on HBAR first would be a break below 10 cents. The technical analysis has to play out and align with the fundamentals as well, right? So we'd be looking for a break of these previous higher lows that created this bullish move, a failure to break these previous highs, a bearish move below 10 cents with the bearish close. Our next bearish targets would be 9.5 cents. If we can break 9.5 cents and we don't see a bullish turnaround from those levels, my next bearish targets would be a further correction of this previous bullish move to come back down into roughly around 8.5 cents. If we break 8.5 cents, worst case scenario would be to correct more of this previous bullish move. The reason why I'm saying that too, I want to give you guys a reason why. Okay, remember that this bullish move, this entire bullish move, all happened because of lower inflation readings, right? So if we see higher inflation readings outweighing the narrative that was created back on January 26 due to lower inflation readings, is it really too far-fetched if we see higher inflation readings to potentially see this entire previous bullish move corrected? I think not, which is why I'm giving you guys targets of around 7.5 cents. Because if we do see 7.5 cents met, where would that put us at heading into April's price action? At a discounted area for banking institutions to get in right around the Bitcoin halving, right? Think about that. Okay. So if we do see it play out, don't get fearful, don't get scared. Price would just be coming back down into a discount from where previous banking institutions bought from at the beginning of January. Just keep that in mind. Obviously, of course, I'll keep the CYPRX students enlightened on that ideology, but the vast majority of retail traders, if from freaking 12 cents, where price action is hovering at around now, pulls all the way back down to 7.5 cents, imagine how many retail traders are going to start talking crap about H bar. They're going to say the market's crap, right? Crypto's a scam. 40% decline from where price action is at currently, which is why I'm trying to warn you guys of the potential possibilities. Like I said, I hope that we don't get scenario number two. I hope that even if we do get scenario number two, price action still continues higher, but we have to be realistic, okay? The reason why this entire bullish move happened was because of lower inflation readings. So in my personal opinion, again, it's not guaranteed. If we see scenario number two, upbeat data, dollar strong, risk off market mood, higher inflation, we are most likely going to correct at least half of this previous bullish move. I would not be surprised if we corrected the entire thing. Okay. So let's be data dependent. Let's see how this inflation data comes out.